Hi, this is Rob Beardsley, and today I'll be walking you through the underwriting spreadsheet and how to perform an underwriting analysis on a multifamily property. So, first, I'll just give a quick run through of the spreadsheet. Specifically, the inputs tab is where you'll be doing all of your inputs. So, none of these other tabs need to be played with as far as inputting data and making assumptions, which is quite handy. So, for now, I'll just stick to this tab and we'll go through the inputs. So number one, most importantly, what we do is we get the whisper price. We want to know what pricing the broker thinks the property will trade at, or if it's an off-market property, specifically what the seller's asking price is. So, and today we're going to be using Surround, a property in Dallas, as the example property. And just to double check, I will remind myself what the asking price is. Okay, we'll assume it's this one. So we'll put that as the whisper price. Now the whisper price input here, it doesn't have a formula sourcing anything from it. It's just a placeholder for us to know what the whisper price is, and we can change the purchase price accordingly. So if we're over 10% off from the whisper, we might just walk away from the deal and choose not to pursue it because we think we'll just be too far off. Similarly, these two inputs are also solely just for your own benefit. They don't no formulas are built off of these inputs, but it's nice to know what the physical vacancy is as well as the vintage. So what we can do is we quickly go to the offering memorandum, the OM, and we'll quickly find the vintage as well as the physical vacancy. So I'm reading here, I don't see it yet. I'll keep going. I don't see it yet. So might have to dig, but nonetheless, some of that information there is quite handy. So here we go. We have 1974 build, and we still don't know the vacancy, but that's all right. But we'll take that information and we'll put it here. Next thing I like to do is the unit mix. So a quick way to do the unit mix is to find it already in the OM. If there's a consolidated unit mix already, I will drag it and share the screen with the OM as well as the spreadsheet. And from here, I will just basically copy the notes. So here I see A1 unit type, 1 bedroom, 1 bath. You could say A1, 1 by 1, A2, 1 by 1, B1, 2 by 1, B2, 2 by 2, and B3, 2, 1.5. And then number of units, it's all the way in the far left, 162, 20, 72, 80, 20. Okay, square footage is right here as well, 619, 756, 869, 920, and 1038. Okay, great. Now rents is where it gets a bit trickier. It's, do you use the market rent? Do you use the in-place rent? Do you believe what the broker is saying? And this is where the rent roll might come in handy. But to start, we'll just do it the easy way, and we'll just assume that the current in-place rent is the market rent, and it's higher than the current market rent, which doesn't really make any sense. Typically, market rents are higher than average in-place rents due to loss to lease, but this here seems to be different. So for now, we'll just use the current in-place rent column to put in our rents. And also, to be overly simple, we will also just take the pro forma rents directly from the OM. No, this is not how we underwrite. No, this is not how we determine our pro forma rents, but just for pedagogical purposes, we're going to use the ones that we see here just to move along. But obviously, when putting together a true analysis, a lot of time, I mean, even though there's all these inputs on this page here, a lot of time is spent simply just focusing on these pro forma rents and then obviously substantiating them via comps. Okay, so now you're lucky, you're able to get the full unit mix right from the OM, which saved you a lot of time. However, what if it was an off-market deal and there is no OM? Or what if the OM doesn't seem to make sense or has errors in it? Well, then we can go old school and go directly to the rent roll. So here you see for this deal package, I have the OM, which is always good to have, but not necessary, the rent roll, which is necessary, and the T12, which is also very necessary, but the rent roll is probably the most important. So typically you want these three things, and then you can perform an underwriting. So the rent roll. Now this is an unconsolidated, raw look at every single unit in the property. And what we can do if there is no OM, or if we want to do this on our own, I will get rid of this extra information here, and I will remove these extra rows and then create a filter on these top columns, and now begin to filter by square footage. So the first one is 619, and here if I sum the number of units of that are 619, I get 162, which luckily matches up here, 162 for the 619 square foot units. So looks like that's working out for us. Now, if I look at the market rent, I'll just make these, well, I guess that doesn't help much, but so market rent, if I look at it and I actually go like this, I can see down at the bottom, average, count, max, and sum. So average and max will be the most helpful here. So, and actually all in one shot, we're able to see that there's 162 units, average market rent is 726, and the max is 825. So I'm not as inclined to trust a max market rent because anyone can make any unit call it any market rent, but what are they actually leasing up for? So, but it's nice to know the average is 726. However, I can go one column over and look at the actuals, and I can see that the max is 870. So it seems that they have a renovated unit that is receiving a premium up to $870 in rent. Let's see if that matches up with the pro forma. Well, the broker thinks you can get 960. So maybe it's only partially renovated and you can further renovate up to that 960 point, or they're just being brokers and being a bit aggressive. So for now, I think what we'll do to be conservative, considering that it's already a pretty big jump from what we have here as an average rent of 743 to 870, I think I'm going to switch my numbers around to reflect that. So I'm going to do 743 to 870. Okay, and as you can see, it's helpful that we're not solely relying on the OM and that we're actually digging into the rent roll to find out what these true rents are and where you could potentially push rents. So I go to the next unit type, and I'm going to just go straight to the actuals, and I'm going to see there's 20 of these units, and they are 756 square feet. So if we go here, we see 20 units at 756 square feet, and we can see that the actual lease is 813 and the max is 949. So again, our numbers are a little off here. I think we'll adjust. We'll go 813 to 949. So it's 813, 949. Okay, so by now you get the point. You use filters on the top to then go and get the number of units for that specific unit type, the square footage, the current average market rent, as well as if there are renovated units, what's the max rent that they're achieving on the property and where can we push rents to, which gives you a rough idea. Obviously, if you do further renovations, you can potentially raise rents beyond what is currently achievable on the property, but that's a good baseline, and for us, that's a really good business strategy that we can get behind if we know that the premiums, if we're underwriting to the premiums that are already on the property, it's a much more compelling business plan. Okay, so we'll stop there since you get the idea. Next, after we fill out the unit mix, we then go to our income assumptions and then our expenses. So let's jump right in. Again, if you stick to the OM, which you already see is potentially fraught, not fraud, but fraught, just has a little more risk relying solely on the OM. However, most OMs will have some sort of underwriting or some sort of T12. And so here they have a T12 broken out by month, which isn't super helpful. But here they do have a pretty helpful page with trailing 12 months, 6 months income annualized with T12 expenses, and then 3 months income with T3 expenses, which is kind of the standard when underwriting this column here. 90-day income versus T12 expenses. So the reason for this is because expenses have a bit more variability than income potentially. So it's always wise to underwrite expenses on a T12 basis. But if the property has seen a more recent uptick in occupancy or recent rent increases, using the 3 months trailing of income numbers can help give a more accurate and current picture of the property's performance. So this here is a valuable tab to use to input our income and expenses. So let's do just that. So first, what I like to do is I like to look at the market rent. Start at the top. It's 3,554. So here, if I look, in this formula here is calculating this. It's just multiplying this with this and adding it and moving along. And so here we're getting to 3.7 million nearly. And the trailing 12 months shows me that they're only at 3.5 million with 3.5% loss to lease. So a true potential rent of I guess here it's actually, they're saying a positive. So what actually these are below market rents, and that explains why in the unit mix it was showing higher in-place rents than market rents. Not the best example, but we'll make it work. So the gross potential rent then is 3.68 million. 3.68 million looks pretty good to me. If we look at the T3, 3.725, so we're actually being a bit more conservative below the T3, which I like being conservative, so we'll keep it at that. And also, I guess we didn't fully go through the unit mix and update all the numbers, so this could also change and not be quite as accurate. So moving on, we look at, since loss to lease here is positive, but we end up washing out, we're just going to put 0, since our gross potential rent is taking into account not only the in-place rents and the loss to lease. Okay, and then we have vacancy, which I'll use the T12 number since it's larger. I tend for income items or for subtracting items, I'll always use the bigger number of any variables, and then for expenses, I'll always use the bigger number as well. And then for income items, positive items, I'll use the smaller number. So I'm basically just conservative all the way around. So vacancy, we're at 346,683. So I'll just put minus 347. I don't feel it's quite necessary to go exactly to the dollar, especially on preliminary underwritings. It saves time. Hopefully it's less of a headache for you as well. And at this point, I'm just going to keep going back and forth, reading these various numbers. And so here I see concessions at 116, and then on the T3, concessions at 125, T6, 130. I'll use the T3, so 125 minus 125. And then bad debt, we'll say it's coming in at 25,000. And then we have other income. So we have utility reimbursements at 376, as well as other income at 139. So we'll go 376 plus 139, 515. So I'll put 515 here, and then I typically just bring that straight over as well to the stabilized assumptions. But we'll deal with stabilized assumptions in a minute. Also, another point to note is although it may be acceptable to jump around to the T3, T6, T12 for vacancy, concessions, bad debt, loss to lease, I think it's important to keep your utility reimbursement income, your RUBS income, as well as all other income on a T12 basis, because there's a more variability in those numbers, and Fannie and Freddie don't let you get more aggressive and underwrite to more recent financials for those numbers anyway. Also, bad debt is a bit more cyclical and discretionary, so on a T12 basis, it's best to keep bad debt to that as well. Okay, so assuming we're done and happy here, we obviously haven't tweaked with our stabilized assumptions, but we're just going to move on to the expenses and try to be as quick as possible. So here we have contract services, repairs and maintenance, pretty much the same line items, and it's the same game, just plug and chug. We're just going to get all of these inputted in. And on these, I'm just doing the T12 because, like I said, expenses are best to be just on a T12 basis. Turnover can also be called make ready, so just beware of that. Same as marketing. Marketing can also be called leasing. So whenever we see marketing or leasing, we'll just put that in our line item here. Administrative at 74,000. And utilities total is 452. 452. Oops. So insurance at 110 we'll call. Oops. Okay, and so one thing you'll see is management fees. Yes, they have them here. And management fees are always a percentage of effective gross income, so based on this number. And so for us, we don't really care that much what their management fee was because they could be using a friend as a property manager and paying them only 2%, maybe 1%, maybe they're the self-manager and they're not taking a management fee, so there's not even a management fee to be found in the T12, the seller's financials. So for what we do is we automatically adjust the management fee based on what we would manage the property at. So here's an assumption here. Are we going to manage, or, are we going to pay a third-party property manager 3%, 3.5%, 4%? Well, whatever that number is, we're going to automatically adjust the T12 and for that assumption because we care how expensive it would be for us to manage it. We don't care what it costs them to manage it. So we have a formula pre-built there. Now, it might be helpful to note in the notes here what the management fee they have in the line item is. So same thing for taxes. We can note on a T12 basis, 368 was their taxes. So put 368. However, you can see that in our T12, we've automatically adjusted property tax as well for what our future taxes will be. Because again, when we buy this deal, we don't have the luxury of paying what they previously were for taxes. We're going to be reassessed and have to pay more for taxes. So to identify the true cap rate and income potential of the property, we want to right off the bat adjust for taxes. So that's what we do. Management adjusted, property tax adjusted, T12. Okay, so now we'll assume all these numbers are good and assume we're not going to tinker with them on our stabilized. Just preliminarily, we're just going to copy and paste them to our stabilized assumptions and how we're going to run the deal. So look, now we've gotten what our potential purchase price is, as well as our income assumptions and our expense assumptions. And of course, we've compiled a unit mix with potential rent premiums. And a handy way to double check what these rent premiums are is just to go to the summary tab and find this number here, average rent premium $161 or 18.6%. So that's a pretty hefty premium. And I know we didn't go through the rest of the rent roll to actually identify what the real premiums on the property were, but you can see that's a pretty aggressive premium, just to give you an understanding. So now that we've entered all the data, now we can look at the assumptions. And this is where things get a bit more challenging, but we're almost done. So for the most part, we keep closing costs at 1% as a whole. As we get closer and we see the cost, we can identify costs better. That number is subject to change. Operating reserves is also a less tweaked assumption because simply we're taking the first months of expenses and we want to have that in cash day one. So if we go to the monthly P&L and we go to the very beginning, the first month has $171,000 of expenses. We want to have that in the bank day one just to be safe and make sure we have operational reserves. Okay, now these are the debt assumptions here. So the first loan, or the senior, we can play around with here. For now, the standard is just 75% LTV. We're going the full duration of the 10 years, whether we're actually looking at the deal as a 10-year hold or not. And then whatever the prevailing interest rates are. And then we just, typically we can get 3 years IO on 10-year paper, 30 amortization. So this is Fannie Freddie debt. So this is just kind of our standard just to see how the deal stacks up. Now we might be doing bridge financing, it might be floating. And if it is floating, a little trick, you click on interest rate and you change it to LIBOR plus, and then you change this number to the spread, not the all-in rate. But we just want to see how a deal looks, one, on an unlevered basis, and then two, with just standard financing. Before we put on pref equity terms or mez debt or assuming any supplementals or refis during the life of the investment, we just want to see how it looks on an unlevered as well as just a standard agency debt assumptions. Okay, that's all I'll talk about there for now. Rehab assumptions. So I have a formula here, which is more of a placeholder, not a strict formula guideline of how long it will take to stabilize the property. And technically what we mean by stabilization, at least within the framework of this underwriting, is simply how long is it going to take us to get our rents from point A to point B. Obviously, we can't buy the property and just increase rents by $100 or $150 immediately and achieve it on every single unit, especially when we're talking about 354 units. So for this deal, we're assuming, based on my formula, 27 months to essentially get from point A to point B. Now, for some people, they might think that's conservative. Some people might think that's aggressive. You'd have to substantiate it by who the team on the ground is going to actually be implementing and carrying out these unit interior renovations. Anyway, so now the costs of doing so. So typically our standard is just $5,000 per unit. That gets us pretty much where we need to be. And then depending on the deferred maintenance or the exterior and amenity expenses that we want to do, whether we want to install a playground or fix some of the parking lot or roof repairs, foundation repairs, renovating the clubhouse, that would be this line item. So I believe in this deal we have a few already renovated units, but as standard, we're just assuming we're going to renovate all units at this price, and then on top of it, we're going to have a certain amount dedicated towards exterior and amenities as well as deferred maintenance. Also, during our renovation period, we're going to see a higher vacancy as well as just lower income because higher vacancy because we're taking units temporarily offline to renovate them, and thus creating more turnover on the property. And this higher vacancy assumption also helps to offset some of our more aggressive assumptions like getting lost to lease burned off and reducing concessions. Here we're assuming we're going to reduce concessions. So that's another way that lets us get comfortable and feel like we're underwriting more conservatively by, again, we can change this and we often do, but as a standard, this is 200 basis points above the stabilized vacancy assumption rate, but we often make it 400, 500, even 600 basis points above the stabilized. So here we are at 7, bump it up to 9. Okay, let's go to our stabilized assumptions. I briefly mentioned the property management fee. This is just who's your property manager, what are they charging you, plug it in. It's good to get the tax rate from, you can go to the county website or the OMs will often say it. If you're here, for example, and we look at pro forma notes, here we have real estate taxes. Taxes are based on the 2018 tax assessment and a rate of 2.682. And we have 2.682. Okay, and then I won't get into how you assess the future assessed value, but this is very important. But we just kind of have standard formulas here. As long as you're seeing a modest bump from the T12 to what we're going to be paying in taxes, it's a good place to start. Next is the annual increase assumptions of rent and expenses. So this is what we have typically, but sometimes we have to get more aggressive and use 3%. Sometimes we're in a market we feel less comfortable with, or we feel like we just need to discount the underwriting, and so we'll go 2%. So that's, again, more of a nuance and definitely important to the underwriting, but in terms of building the foundation of the underwriting to then be modeled with and tweaked and worked on, that's an important input. Next is vacancy rate. Again, it's just knowing the market, studying the market, looking at the trailing occupancy, and making our assumptions from there. Loss to lease, something similar to that, but we typically hold it standard at around 2%. Concessions and non-revenue units are very deal specific. Bad debt is specific to the market, so it's good to understand what deals are typically having in bad debt. This reserves, we rarely change. We put reserves above the line as well, so it's in our expenses, so it actually reduces our capitalization and our projected value of our properties when we exit, as well as refinance. So we feel that's just another way we're being conservative overall in our underwriting. Lastly, our exit assumptions. So as a placeholder, we have the terminal cap rate widening by 100 basis points above the entry cap rate. However, that is just a completely terrible and oversimplified worldview, and we definitely do not abide by that rule in a hard and fast way at all. This is just a placeholder. And again, this is also a very nuanced input and something that is deliberated on a lot. So not something to just quickly input and move on. And then these last ones we pretty much hold constant. It's nice to see a deal play out on over 5 years, up to over 10 years, so we can, or a shorter hold period, even 3. But 5 is a good middle ground. And then for longer term holds, it's good to show investors a full 10-year term on an investment. Okay, so I think that pretty much wraps it up on how to input the unit mix and the income and expenses. One thing we didn't go over, or at least show, is the T12. So, luckily we were able to use the OM to grab T12 and T3 income and expense data. However, again, we aren't very trusting of this all the time, and it's very good to reference the raw numbers of the T12. And so here what I did is, actually I cheated, I've done this before, is I go to view and I click freeze first column, and now this first column here with all of the line items is frozen, and I can drag over and go to the total and more clearly see, okay, gross potential rent to this total, and so on. And so here are the raw numbers, and from here I can take these totals, for example, total contract services, take this, copy and paste it over to our underwriting. Additionally, what I did here is, I'll do it again, I go equals sum of the last 3 months multiplied by 4, so I annualize the trailing 3 months, and then I click here and drag it all the way down to NOI. And now I can compare quickly the T12 versus T3 and make my assumptions and inputs accordingly. Okay, so that is, again, a brief rundown of underwriting properties through our model and referencing the rent roll and the T12. Thanks.